So what happens when you buy a put option? So let's go through with an example for Apple stock. So today's a Sunday, and this price is as of Friday's closing, and Apple's spot price, that is the immediate price, is trading at 198.78. So let's go to a spreadsheet, and we're talking about Apple. Spot price is 198.78. We are talking about a put option. Let's look up an example. So the maturity is June 28th, so 1 week, and we're going to look at put option that is, say, $200. So put option, strike price is 200, and let's go through different possible prices for Apple. So if we start with, say, $200, well, 198.70, that's the price right now, and our strike price is 200, and the current Apple price is 198.78. So we'll talk about the exercise value or exercise price. So think of it like this. An option price is or has two components: the intrinsic value and which is the exercise value, and premium. The premium is unknown, and it depends on variables such as volatility, time to maturity, distance to the spot price, or strikes distance to spot price, risk-free rate, and etc. So our exercise will only focus on the exercise value or intrinsic value simply because it is known and it can be calculated, and we will just leave the premium discussion for a later lecture topic. So the exercise value in this case for a put option with a strike price of 200, if the Apple price is 198.78, now with a put option we have a right to sell at $200. So if we sell at $200 and buy it back at 198.78, we actually have an exercise value of 122. Now, if the price goes down further, keep in mind we have a right to sell at $200 because we have a put option with a strike of 200. And if we sell, meaning if we exercise this, and if we sell Apple shares at 200 using the option, the current price is 195, so we could buy those shares that we just sold at 200, and we can buy them back at 195, which gives us an exercise value of 5. If the price goes down to 190, it's the same. We have a right to sell at 200 through our option, and we can buy those shares back at 190, gives us a $10 off an exercise value. An extreme value, 150. We can sell at 200 using our option, and our current price of Apple is at 150, so we can buy them back at 150, gives us an exercise value of $50 per share. So if we see the price going up, say 200, well then we are indifferent to selling to the market or selling to our option, which means that our exercise value through this option is 0. If the price goes to 210, now notice we have a right to sell at 200, but the market is at 210. So why would we sell through the option at 200? It just would be, we would just realize a loss. So we would never do this. Therefore, our option loses value. We wouldn't exercise it, and therefore the exercise value would be 0. If the price goes to 220, the same deal. We can sell to market at 220. Why should we sell to our option at 200? Which makes our option price exercise value equal to 0. Say the price goes to 250. Again, we have a right to sell at 200. But why should we, when we can sell it at 250 to the market? So our exercise value is 0. Well, we paid some money to buy this option. So let's take a look at exercise value after original purchase price. Right? So think of it like this. In order for us to buy this option, we have to pay $3.20. And after we pay the $3.20, and only then, we own the option. So our exercise value minus what we pay for it is the true value of this option as an exercise for us. So let's look at this, minus $3.20, right? And then this minus $3.20, and this minus $3.20. Now notice our exercise value actually goes down by the initial $3.20 that we paid for it, which is a sunk cost. So the same applies even if the price goes up. Right? So the discussion about this is when you buy a put option, when the price starts going down, you actually have an potential to make unlimited, well, not unlimited, but the price can go down to zero, right? In which case you would have a maximum of $200, in which case your actual profits would be $196.80. So you have an incredible amount of profit opportunity by buying this put option. However, if the price starts to go up, well, then the only thing that you're going to lose is how much money you paid for it. But notice, buying an option is not an investment. It's betting. You basically are buying a put option, and you're paying money for this derivative security that has an expiration date. Therefore, the $3.20 per share that you paid is a sunk cost, and you actually paid it, and it is long gone. Now, you wouldn't lose anything above and beyond that when you're buying this option. However, you have the potential to make good amount of money if the stock price starts to go down. So that's what happens when you buy a put option. Thank you.